What if you could turn a small amount of money into millions over time? It sounds too good to be true, but with the right strategies, investing in the stock market can help you build wealth and achieve financial freedom. Today, I'm going to show you exactly how to get started with investing, even if you're a total beginner. Whether you're starting with just $100 or you've got $10,000 to invest, this guide will walk you through everything you need to know to grow your money and start thinking like a millionaire. By the end of this video, you'll understand how the stock market works, the power of compound interest, different types of stocks and investment strategies, how to choose your first stock, common mistakes beginners make, and how to avoid them, the difference between long-term investing versus trading, and tools and platforms to get started. This is your step-by-step tutorial to kickstart your investing journey, and it's designed to be simple, even if you're starting with zero experience. Let's start with the basics. How does the stock market actually work? At its core, the stock market is a place where people can buy and sell shares of companies. When you buy stock, you're purchasing a tiny piece of ownership in a company, and over time, as that company grows and makes a profit, your share of the company increases in value. Now, the stock market might seem like a chaotic place with its daily ups and downs, but the key is long-term investing. If you choose solid companies and hold your investments, the market tends to reward you with growth over time. Here's where the magic happens: compound interest. Think of compound interest as your money making more money. It's when you earn interest on your initial investment and the interest that accumulates over time. Imagine you invest $1,000 at an annual return of 7%. After the first year, you'll have earned $70. But in year 2, you'll earn interest on that $1,070, not just the original $1,000. Over time, this process can grow your money exponentially. So the earlier you start, the more you can benefit from compound interest working in your favor. Now, let's talk about the types of stocks you can invest in. There are two main categories: growth stocks. These are companies that are expected to grow rapidly over time. They tend to reinvest their profits back into the business, so they might not pay dividends. But the idea is that their stock price will go up significantly as the company grows. Think of companies like Tesla or Amazon. Dividend stocks. These stocks pay a portion of their profits to shareholders in the form of dividends. Dividend stocks tend to be from established companies, and they're great if you want steady income from your investments. Companies like Coca-Cola or Procter & Gamble are examples. When choosing a strategy, it's important to know whether you're investing for growth or income. Most beginners start with growth stocks, but some prefer a mix of both. When it comes to choosing your first stock, don't overthink it. A good rule of thumb is to invest in what you know. If you love a certain brand or use its products, chances are you'll be familiar with its performance and potential. A great place to start is with large, stable companies. Look for companies with a strong track record, consistent revenue, and a competitive edge. And don't forget to diversify your portfolio, which means spreading your investments across different industries and companies to reduce risk. Let's talk about some common mistakes that many beginners make and how to avoid them. Chasing short-term gains. It's tempting to try and time the market, but remember, it's long-term growth that wins in the stock market, not diversifying. Investing all your money in one stock or one sector can be risky. Spread your investments across multiple assets. Reacting to market volatility. The market will go up and down, and that's normal. Don't panic sell during a downturn. Stick to your long-term strategy. The key to successful investing is staying consistent and sticking to your plan. Now, you might be wondering about the difference between long-term investing and trading. Long-term investing is when you buy stocks and hold them for years, letting your money grow. It's ideal if you don't want to spend all your time watching the market and looking for quick gains. Trading, on the other hand, involves buying and selling stocks frequently, trying to take advantage of short-term market fluctuations. While some traders make money, it's much riskier and requires a lot of attention. If you're just starting out, I recommend focusing on long-term investing. So, what tools can you use to get started? There are plenty of great platforms out there to help you invest, such as Robinhood, Fidelity, or Wealthsimple for Canadians. These platforms allow you to buy stocks, track your portfolio, and even set up automatic investments. Don't worry if you don't have thousands to invest right away. Many platforms allow you to start with as little as $5. The key is to start small and keep adding to your investments as you go. And there you have it, a beginner's guide to investing in stocks. Whether you're starting with $100 or $10,000, remember that investing is about patience and consistency. By using the power of compound interest, choosing strong stocks, and focusing on long-term growth, you can set yourself on the path to financial freedom. If you have any questions, drop them in the comments below. I'm here to help you start smart and stay consistent. Don't forget to like, subscribe, and turn on notifications for more investing tips and financial education. Thanks for watching, and I'll see you in the next one.